All right, in this video I want to talk about how life insurance policy loans work and why it's so much better than paying cash. Now, before I get into it, I'm going to explain how do we obtain money from the life insurance company. Then I want to talk about how it's different than paying cash and what the benefits are. And then I want to talk about, what's the overall outcome and how does that affect you over your lifetime. Understand, a lot of wealthy people use this strategy and you're going to see why. Now, the first thing I want to show you is how the life insurance policy works inside a life insurance company. Now, when we put our money inside of a life insurance company, and I'm talking about a specific type of life insurance company, they're going to go out and they're going to take that money and they're going to invest it and they're going to earn an interest rate. So we have what's called our life insurance policy and it's earning this interest rate. How? Because the life insurance company is taking our money and investing it, and then they're going to come back with that investment, and they're going to put the majority of those profits back with us. In these companies, we are owners of the company, basically, by having a life insurance policy, and we're going to earn an interest rate based on company earnings, which is called a dividend. So this is going to happen whether we're using our own money or not. When I say using our own money, what I mean is we use this money by taking life insurance policy loans. So if the life insurance company is earning an interest rate and they're paying us an interest rate, then what we're doing in this situation where we go and take a life insurance policy loan is we're in essence becoming their investment over here. So the life insurance company, when we take a loan, they're going to charge us an interest rate over here based on their investments that then comes back to the company, that then in essence comes back to us because our policy is growing whether we take loans out or not. So all we're doing is stepping in the place of the investment and replenishing the money that we're borrowing based on what their investment would have been this year. So this is why a lot of people will say you're paying yourself back. Even though you're taking a loan from the life insurance company, it's in essence your money and you're going to recoup a majority of that interest over here on the back end because you are the investment in one situation and you are the policy owner on the other situation. So that's kind of how it works. Now, why would you want to take a policy loan or why would you want to take a loan over paying cash? That's naturally the next question. Most people in their life, they go from being in debt to paying cash, and they wonder, why would I want to take a loan or go into debt again? Well, there's a simple reason, and it's called compound interest. Now, let's talk about two people. One's going to pay cash, and the other is going to take a life insurance policy loan for his lifetime. Over his lifetime. We're going to look at two people. Let's just say, for ease, that they are 35 years old today. They're going to buy 5 cars over their lifetime. So they're going to save up $5,000 a year to have $25,000 every 5 years. And every 5 years they're going to buy a new vehicle. Okay? So let's look at this as circular. And what I mean is, we have to understand that all this guy is going to do is he's going to save the money for 5 years into an account. If he's going to pay cash, usually it's a bank account. He's going to save up that money. Then he's going to take it and he's going to buy the car. And then what's he going to do? He's going to begin to resave that money or pay it back until he has money again in 5 years to repeat the same process, and he's going to do this over his whole life. Well, the question is, if that $25,000, and this is the real point of all this, if he would have taken that original $25,000 and put it into an account where it could grow, how much money would he have at the end of his life? This is called opportunity cost. By paying cash and spending all that money, he's lost out on the future value that $25,000 in this scenario would have earned or would have grown to. All we're doing in a life insurance policy is saying we're going to let this money grow, and at the same time we're going to pay back the loan so that our money can continue to compound and grow for our entire life. And the result is huge. So that's what I have over here, is this guy who's using a life insurance policy, or girl. So we got to understand that from 35 to 40, so the first 5 years they're saving the money, and then the next 5 years they're paying it back. They're resaving it. So 10 years in, year 10, over here, in the life insurance policy, he now has $30,929 in his policy. And we have to also remember, and this is all at 5%, I'm using 5% here. That's today's kind of rate. He has paid now $3,300 in interest. So you can see already he's paid less interest than he's earned. As time goes on, the difference just becomes bigger and bigger. Year 15, he's paid $6,600 and he has $41,000 in his account. Year 20, year 25, by year 30, by the time he's about to retire, he has $100,000 in his life insurance policy, and he has paid $16,500 in interest. A very big difference. At the end of this, his life insurance policy is going to keep growing even through retirement, and the results just continue to get more and more dramatic. This guy over here who paid cash, he has $25,000 in his account at the end of it because he's repaid it back, obviously. And over here, this guy has about $75,000 more. Over time, it's going to end up being, around $100,000 even more in a difference. So what's the real difference here? Well, we let our money compound for our entire life. We didn't lose out on that opportunity cost or the ability for our money to grow through our entire life. When we pay cash, we lose out on the opportunity to do that. Now, if we're looking on a day-to-day, what's the day-to-day difference? Well, we have to understand that there is a difference from month to month between the guy that's paying cash and the guy that's using his life insurance policy. If we're looking at this on a monthly basis, we have to understand that the guy who's paying cash, he is saving up $416 a month to save up that $5,000 a year. The guy who's using his life insurance policy is saving $471 or paying $471 a month. So the difference is about $50 for about $75,000 difference when you hit 65 years old. This is kind of the other part of this, is that, look, yes, it costs you $50 a month. It costs you $16,000 in interest, but the benefit is so great that this doesn't matter. Now, this $50 a month, there's what's called Parkinson's Law, which basically states as your income rises, your spending rises. And it goes the other way. If you took $50 a month out or you were paying $50 extra a month in interest, I think you would adjust. If you had $50 extra a month, you're probably going to adjust up and find a way to spend that money. The difference is small on a monthly basis. The difference is significant over your lifetime by letting your money compound. This is just one of the ways that life insurance can be a huge tool to have huge benefits over your lifetime. Financing and purchasing cars and other things is one of the major benefits here that we're going to find by using life insurance and high cash value life insurance to make these purchases. This is Josh Thompson. Thanks.